In the beginning of the COVID pandemic, people started to realize that you can't depend on only one source of income, especially those who lost their income during the initial lockdown. People all around the world started to look for different ways of generating an income, from Ponzi schemes to stokvels, pyramid schemes, and some people even started to invest. Although it's a great thing that more everyday people started to invest, there's certain mistakes that beginner investors make and fall prey to that can completely wipe you out. In this video, I'll be sharing some of these issues with you, and we'll be looking at what causes financial disasters and how we can actually avoid them. When it comes to investing, it all boils down to how much money you can make versus how much money you lose. Warren Buffett, the world's best known investor's number one rule is to never lose money. His second rule is to never forget the first rule. So it's important to understand that investing is all about gains and you want to minimize your losses. So what are some of the quickest ways to financial disaster and how can we avoid them? Number one is leverage. This is when you take out a loan or use margins to invest in stocks. Even though leverage is a great way to realize great returns and to maximize your profit, the same counts if you have bad returns. Let's say, for example, you have 5,000 Rand cash and you take out an additional loan for 5,000 Rand, and combined you have 10,000 Rand to invest. So let's say you invested the 10,000 Rand and your stock goes up with 25%. Then the combined 10,000 Rand goes up with 25% and you will realize a gain of 2,500. And that is great because if you only invested the 5,000 Rand without the loan amount of 5,000, your gain would have only been 1,250 Rand. The same is true if your stock goes down in 25%. And this is where it can get real scary. So let's say that same example, 10,000 Rand goes down with 25% and you sit with 7,500 Rand. The problem here is that you still owe your lender 5,000 Rand. Now suddenly you only have 7,500, which 5,000 Rand is owed to your lender. This doesn't seem too bad if you are still able to cover your shortfall and you're able to service your debt to your lender. But let's say worst case scenario, you can't service your debt and you have to sell your stocks for a loss. This is what causes financial ruin. So stay away from using leverage to invest unless you are prepared to carry those shortfalls and still service your debt. So basically my advice to you is to not use leverage for investing. The second thing that can cause financial disaster is investing in non-productive assets. So I don't care if you want to hold cash, Bitcoin, gold, or artwork, or whatever it might be, the one thing you should ask yourself is how much of your portfolio are you dedicating to items like these? These items that are listed are all non-productive assets. Put simply, these items that are listed has no intrinsic value and you can't determine the underlying value of these items. These items function on supply and demand, and it's simply what the next person is willing to pay for that item. While you hold these items, they do not produce cash or have any underlying value. When you buy shares in a company, you own a percentage of a business, and this business produces cash, and we as the investors can calculate an estimated return on our investment. This is great because we can determine the intrinsic value of the business and what we are willing to pay for this company. Non-productive assets like gold and Bitcoin have no intrinsic value and are simply a supply and demand item. It's about what the next person is willing to pay for them. In good times, the next person will always be willing to pay more. But what happens if there's an economic downfall or the sky is falling and things don't look as good anymore? We just need to understand that it's okay to have a percentage of your portfolio invested in these non-productive assets. These assets can give you huge returns overnight, but we have to understand that that is not the norm and someday it might just change. So just be sure not to have too much invested in these non-productive assets. The third thing that can cause financial disaster is speculating. This is simply investing in things that you do not understand. Investors get wiped out all the time by investing in things that they do not understand, and as soon as the stock goes down, they panic and they sell for a loss. So don't buy things just because an ad on your Facebook says you should invest in it, or a oom at the braai says that this is a great investment, because this is known as speculating. Stick within your circle of competence and only buy things that you understand. This means if the stock goes down, you will be happy knowing that you want to invest more and you will ride the wave until you have big profits. You won't be hesitant to buy more because you understand the value of the company. So what happens if you buy a company that you don't understand and the stock price drops with 50%? Do you stay invested? Do you buy more? Or do you ride the wave until the end? This can confuse you and cause you to make unnecessary mistakes. So don't invest in stocks or assets that you don't understand. So number 4 is probably the most important, and it ties in well with number 3, and that is to have a short-term mindset. Having a short-term mindset causes financial disaster all the time. If you have the next 3 to 6 months in mind when investing, you should rather stop and run away, because this is a recipe for disaster. To make solid returns in the stock market, you need to have a long-term goal in mind and be patient and stay invested for at least 10 years to realize solid returns. If you are short-term minded, here's what's going to happen. You will be disappointed with ETFs and their average returns. You'll be disappointed with long-term stocks, and you will start to chase returns and speculate and bet on items that you do not understand. You'll have FOMO because the newest crypto has gone up with 20%, and this will take you on a road of financial disaster. Good investors are patient and wait for the right opportunity to invest in a solid company that they know they can hold on forever. They ask themselves if this business is going to be worth more in 10 years. If yes, they hold on to this company patiently. So simply don't get caught up in the short-term mindset and get greedy to chase returns. This is a one-way road to bad investing. So there we go, guys. These are 4 things that can lead to financial disaster, and these are the main ones that you should avoid when you are a beginner investor. I hope that this will help you fast track your road to financial freedom and that you will know what to avoid when you start investing. With that said, thank you guys for watching. I hope this video helped you in some way. If it did, give it a thumbs up, subscribe to my channel, and share this with your friends and family.